Welcome back. It used to be said that a home is one's castle. Not anymore. Privacy? Not so much. I found a recent story in Money Talk News that may be impacting your existing reverse mortgage borrowers or those that are seeking a reverse mortgage when it comes to home insurance. And you're going to find it unsettling because it's not just affecting older borrowers. It will impact any of you that own a home and currently have homeowners insurance. Let's go to the column. Insurance companies are using drones to jack rates, cancel policies. 5 ways to fight back. And this is quite an unsettling photo. If you think your backyard is your private sanctuary, think again. Your insurance company is likely spying on you from above, and I promise you it isn't doing it to admire your landscaping. They're looking for an excuse to cancel your policy. And Money Talk News cites a recent Wall Street Journal column which notes that insurance companies are not just using drones, they're using airplanes and even hot air balloons to spy on their policyholders. Can you believe it? In fact, an industry-funded group called the Geospatial Insurance Consortium has reportedly photographed 99% of American homes from the air. That means all of us are likely, in that database of photographs. In essence, these companies are using surveillance, digital surveillance, to look for any reason that they can find to cancel a policy they deem to be high risk for a future claim or to increase the monthly premiums. We're seeing homeowners lose their coverage over a little moss on the roof, an undeclared backyard trampoline, or tree branches hanging a bit too close to the gutters. But as is often the case, technology can get it wrong, and so Money Talk News gives 5 tips for your homeowners or your older homeowners or even yourself to fight back if you're facing one of these cancellations or an increase in premiums due to digital surveillance. First, demand to see the evidence. If they send you a non-renewal notice based on an aerial image, don't accept it, fight it. Ask your insurance company or agent to show you the exact photos used. Sometimes the images are 2 or 3 years out of date, and in some cases, artificial intelligence simply misinterprets what they're seeing. And for those photos that are out of date, they may not reflect any mitigation that has been done on behalf of the homeowner to reduce risk to the home, perhaps trimming back trees or eliminating the moss on a rooftop. Second, which is always wise, is to shop around and bundle. If your current provider hikes your rates or threatens to drop you, shop the market immediately. Frankly, you should be getting quotes every year anyway. And while you're at it, bundle your home and auto insurance policies with the same carrier. The third tip is to be proactive and fix issues before they become a point of cancellation or an increased insurance premium. If there's a trampoline or a drained swimming pool, that needs to be resolved immediately, especially before that surveillance photo catches that infraction. Next are deductibles, because there is a big variance in premiums based on how low the deductible may be. So if a homeowner or one of your reverse mortgage borrowers has a $500 deductible on their property, which by the way is pretty common, you may want to encourage them to look at a higher deductible, which could help ease the financial pressure from the increased premium. In the end, this story is more than just about the loss of privacy, even within our own backyards. It's about housing security for our older reverse mortgage borrowers. Guess who's back in the news again? It's Novad Management, a name that many reverse mortgage professionals know well for their infamous lack of servicing of HECM loans that were an assignment to Housing and Urban Development. But now there is another twist when it comes to the former servicer of HECM loans. And for this, we go to HousingWire. First American Title Insurance Company and First American Mortgage Solutions, LLC, have filed a federal lawsuit against Novad Management Consulting, LLC, and they allege a breach of contract, and they're seeking to secure more than $1.6 million in disputed payments that are tied to reverse mortgage services. The injunction, filed on March 30th in the U.S. District Court for the District of Maryland, asked the court to issue a writ of attachment against Novad's bank accounts, or alternatively, to grant injunctive relief to prevent the company from moving or dissipating assets while the arbitration proceedings are pending. This lawsuit comes as Novad is already under scrutiny from the CFPB, or the Consumer Financial Protection Bureau. In 2024, they ordered the company to pay roughly $11.5 million in restitution to borrowers, and they also barred them from any future reverse mortgage servicing, finding they had engaged in deceptive practices. First American says that Novad failed to disclose the 2024 enforcement action and the subsequent settlement with HUD while assuring that it would pay their outstanding debts, a claim that now underpins their efforts to secure more than $1.6 million through arbitration and the courts. This story just confirms the serious harm that can be done to older homeowners with a reverse mortgage when operational discipline breaks down with the servicer. How or why this was allowed to go on for so long, we'll never know, but thankfully Novad is no longer the servicer for HECMs held in assignment by HUD. But it's also a real good reminder that when there's a hiccup in servicing for a traditional mortgage borrower, it usually doesn't have such dire consequences. However, for an older homeowner on a fixed income, it can be devastating. Last week, I came across a gem of a column in the Chattanooga Free Press, which really looks about the suitability of a home to age in place. And it says that one should be asking the 20-year question as to whether they should remain in the home. And that's something, of course, that does directly impact older homeowners. And it may become part of our conversation, or perhaps it should, for reverse mortgage professionals. Let's jump to the column. It says Darlene Gray has been a widow for 17 years, but has only just left the Delano, Tennessee farm that she and her late husband shared more than 3 decades. 38 acres, 2 homes, a giant out barn, organic fields, and 17 acres of hardwoods, said Gray, age 67. I tried my best to maintain it, but it's very costly to pay people to work on farms, and it's isolated. That's no good for me at my age. I need to be in a one-level home, she said. It's time. And Mrs. Gray is not alone, according to recent research from the National Association of Realtors, which shows that this is a common and widespread issue. NAR's 2025 profile of home buyers and sellers, the median age of repeat buyers is now 62. That's a record high, and 49%, or nearly half, of all home buyers in 2025 were over the age of 60. And this, for me, points to a massive opportunity for the HECM for purchase. One Chattanooga-based realtor estimated that in the past 5 years, 2/3 of his business has been comprised of grandparents moving to the scenic city. The NAR report also points to downsizing as the common motivation for home buyers over the age of 60 to purchase a new home. Chris Scott, Gray's real estate agent, says that his client could have stayed on her farm a little longer, but she was being proactive. That is one of the key takeaways in this column. If an older homeowner takes steps early and looks ahead 20 years and says, is this home really going to be suitable for me to age in place, and then takes steps to perhaps sell within a year or 5 years, then they'll be better off than facing a health crisis, and that leaves them fewer options in the future. Gray's realtor says her new home in Cleveland, Tennessee is 2,100 square feet on one level and has custom doors. So what type of properties are home buyers age 60 and older purchasing? According to NAR, Gray is among the 60% of buyers 60 and older who decided to get a single detached family home, and 14% picked a duplex, apartment, or condo, while 11% opted for townhomes or row homes. In closing, here's one consideration for you, reverse mortgage professionals. If you're meeting with a potential HECM borrower and they simply don't qualify, or perhaps they do, but you can see that aging in place is going to be a challenge, it may be a good idea for them to sell and downsize or right size, and then they can perhaps qualify with a HECM for purchase. And that is meeting the needs of the homeowner, not just in the moment, but long term.